Why it's important not to let the results of an election dictate how you invest for your future in this week's Fastest 4 Minutes in Finance. Hello, and as always, thanks for checking us out. I'm Scott Inman. As we record this, the midterm election is over, but control of the U.S. House and Senate is still undetermined as many races across the country are too close to call. Last week, we showed you that the stock market has historically performed well right after the midterms. In fact, the fourth quarter of a president's second year and the first quarter of a president's third year are the best quarters on record. And if you look at this chart from Invesco, you'll see the year after the midterm elections have been the best year of a president's term. Using the Dow Jones as our measurement from 1900 through last year, year one averages 11.5%, year two is up on average 7.2%, year three is the best at 16.6%, and year four averages 12%. These returns are regardless of the outcome of the midterm elections. You can see to the right of this chart that it doesn't matter too much which party wins. The trend line is similar whether the election creates a single party control or divided government. The Dow historically goes down in the 12 months prior to the midterms and goes up in the 12 months following the election. The real driver of the market is not politics or elections, but the economy. And the policy making that matters more is monetary policy. Another chart shows the U.S. Financial Conditions Index from 1990 through 2022. And that's a weighted average of riskless interest rates, the exchange rate, equity valuations, and credit spreads. In other words, when economic conditions were good. The shaded areas are periods of easing financial conditions, meaning low inflation and easy monetary policy. And you can see, regardless of who is president or which party has power, the S&P performed best when economic conditions were best. Politicians like to blame the other party for the bad times and take credit for the good times. But here's the truth. There are external factors that affect the economy no matter who is in charge. And the economy affects the stock market more. So if you didn't like the results this week, if you feel your party didn't win, stay engaged. Work for a different outcome. But don't let it drive your investment decisions. Our final chart shows the growth of a $10,000 investment in the Dow from 1900 through 2021. There are 4 lines on that chart. If you remained invested throughout that entire time, your $10,000 would be nearly $10 million. If you decided the world was going to end if the Democratic Party was in charge and invested only when Republicans were in charge, your $10,000 would be less than $100,000. If you preferred the Democratic Party to be in charge and invested only then, you'd have a little over $100,000. And if you only invested when power was split, you'd have roughly the same outcome. Bottom line, elections don't sway the stock market over the long term. What does sway the market is the economy. And anyone who's bet long-term against the U.S. economy has lost. There's no reason to believe it will be different in the future just because someone else is in charge. Thanks for listening.